From the Zoomerplex in historic Liberty Village, The Zoomer, hosted by Libby Znaimer.
Welcome to The Zoomer. I'm Libby Znaimer. Retirement is not what it used to be, a hard stop at the age of 65 or before, followed by a limited life expectancy. Mandatory retirement is now against the law, and even after leaving the full-time 9-to-5, many Zoomers continue to move in and out of work commitments, depending on what they need and what they want. Managing the money in the midst of changing life circumstances is complicated. There's the Canada Pension Plan, which we have paid into throughout our working lives, along with old age security from the government. We have the choice when it comes to collecting CPP, and the choice will determine how much we get. And what about those RSPs that lowered our tax bills throughout our working lives? Well, they have to be converted to RRIFs at age 71, and we have no choice about drawing them down and paying the taxes that come due. So, how to navigate all those decisions? With me at the Zoomer Roundtable are Jackie Porter, Jamie Golombek, Jason Pereira, John Melinte, Keith Ambachtsheer, and Rudy Buttignol. Well, the first big decision is when to take your CPP. We think of 65 as the usual time, but you can begin receiving it as early as age 60 or as late as age 70 or anywhere in between. Take it early and use it as you wish, or defer it and collect more. Sometimes a lot more. Jason.
So I think there's two key factors here. The first is, can you afford to defer, right? Are you in a situation where you have enough money to float yourself in order to basically put off CPP? And then in addition to that, are you facing any kind of health crises? Is there anything in your life that limits your life expectancy? That too has to come into play. But if not, in general, when you look at the math, delaying CPP to 70 is highly advisable. And the reason is because on paper, when you look at it, if you start at age 60, you get 36% less. It's basically 0.6% less per month pre-age 65. You go past 65, it's 0.7% more, up to 42%. But here's the thing. It's not just negative 36 or positive 42. CPP goes up by more than inflation every year. So you're getting 36% of a lower number or 42% of a much bigger number in 10 years' time. When you do the math, you're going to get up to 2.5 times at 70 what you would at 60. That is a big number, guaranteed to be indexed to inflation.
It seems to be a tough sell, though.
It's tough. People want the money now. This is what we hear all the time. I'd rather have the money now, and even though I'll get this later, I'll enjoy it now. But you know, as Jason was saying, that is often the wrong decision. I mean, if you look at the math behind a lot of this stuff, the message I say is if you are in relatively good health and you don't need the money, defer till age 70. It's that simple.
What's your take on that?
You can't deal with the math. It is what it is. And these are behavioral questions. And we're only human, and we do what we do for the reasons we do it, and it's not always rational.
What about women? Women, the actuaries say, live longer than men. So it seems like it's even more of a thing for women.
It should be a no-brainer for women, or an important conversation for them to have with their advisors. Because often, you know, we take off time to have children, we tend to make less and we live longer, and we often don't have enough saved for retirement. So if we know all these things to be true, it would be a challenging conversation later on to have with yourself to say, why didn't I save? Why don't I have as much money as I hope? So leaving your CPP till later and having that extra money, especially if you know you're going to likely live longer, is so crucial for a retirement plan for females.
Now, I have to say, I have a big cancer history, but I always seem to survive. I took quite offense when I had financial planners saying, you should take this as early as possible.
But it's actually the smart advice. I mean, at the end of the day, if someone does have a theoretical shortened life expectancy or shorter life expectancy, getting the money sooner means ultimately potentially more money at the end of the day if you don't live till average life expectancy.
What do the actuarial tables say about that? I mean, there are I don't know the number of cancer survivors who go on to live long and happy lives.
No, absolutely. What you have to think about is that the actuaries that work at the CPP, when they cost these things out and they come up with the adjustments of 0.7% or whatever, they're doing it for the average population. So it's almost like a game where now, unfortunately, you have more information than they do. So if you've come down with a disease like cancer, you know something that they don't, and you can, at least financially, you can get some advantages there by taking it.
It seems to be a hard sell, Rudy.
Well, you know, if we were only rational beings, then clearly we know what to do. Take it as late as possible. But we're not rational. We're also emotional. And as you age and your friends around you, people your own age, start to pass away, it is unnerving. So the temptation to take the money now because, you know what? I don't know what happens tomorrow. And once I die, those payments end, right? So.
I mean, you're talking about being able to float yourself, but a lot of people are still working at the age of 65.
And if they're still working, then they may be in a different situation. What if they're already at the situation where they've already maxed out their contributions to CPP? And it is possible to max out your maximum benefit and still be working. Now, you typically have to work past 65 for that to happen, but let's say someone's 68 years old. They could have reached full benefit prior to retirement, and they are still making contributions to CPP because they come off the payroll. But that's not increasing their benefit. So unfortunately, there is a situation where you could overpay for CPP.
I hear from people who say, well, what if I die before I collect the maximum? I mean, you're not going to be worrying about it then.
You have bigger problems, like not breathing. So.
Exactly.
Yeah.
And what about survivor benefits for CPP?
So there is a reduction, right? So it depends upon how much the person was collecting in the first place, how much the survivor was collecting as well, right? So there is a combined survivor and retired threshold that cannot be exceeded. So unfortunately, in cases where there's dual incomes and one person passes away, you're seeing a disproportionate reduction in the household income of both people, where basically you're right at the maximum. And in cases where they weren't at the maximum, then that offset is only a percentage. It's not the full amount. So you end up basically not seeing a clean reduction.
Yeah, and that really being the case, even a bigger reason to really max fund and defer CPP until later, because you really want to show, when we work with clients, we want to show people if one spouse dies and the other spouse is there, what's going to be the impact to their lifestyle and to their income? What's going to happen to the CPP benefits? Will they end up in a scenario where that spousal allowance is so much less? So often we recommend at least one person should consider deferring CPP until later.
We need to take a short break. We'll be right back with more of the Zoomer. Welcome back. While there's almost too much choice when it comes to claiming CPP, you have to start collapsing your RRSP and paying tax on your withdrawals the year you turn 71. The government has a schedule and you have to take the minimum each year, whether you need it or not, and whether you want it or not. No wonder Zoomers have anxiety about whether they will outlive their money. Getting rid of, or at least lowering mandatory RRIF withdrawals are key parts of the CARP platform and have been for years. Rudy.
Well, CARP's taken the position that there's really no need to be taking, RRIF payments at that specific age. A lot of our members, a lot of seniors continue to work after 71 because they want to, or in many cases because they have to. And with inflation being what it is, the cost of living, more and more seniors are working. So CARP has taken the position that we're against mandatory withdrawals at the age of 71.
I was talking to a friend of mine just on the weekend, and she said the idea of control really bothers her. She wants to have control about when she takes that money. and when she pays taxes on it, Jamie.
Yeah, I mean, there's a lot of arguments for, at least lowering the minimum amount that you have to take out each year. So, for example, age 71, you convert your RSP to a RRIF. Age 72, you have to take out about 5%. It goes up every single year until age 93, you take out 20%. But a lot of people said, well, I don't need the money. I don't want to have to take it out. I want to be able to control when the money comes out and thus how I pay the tax. The government's only argument against this is that they want the money. In other words, if you actually ask the government and you look at their literature, they actually need the revenue because you've gotten a tax deduction when you put it into your RSP. They want to be able to collect that revenue when you take it out. So I think there are very good, people are living longer, people, there are very good logical reasons for the government, and they have, over the years, done things. They've lowered the minimums, a while ago, and they could do so again. So I think it's a legitimate concern, and it's something that many people are lobbying about for sure.
Truly, more and more people cannot afford to retire. That's what the numbers say, is that, as you mentioned quite rightly, most people, there's quite a few people who are not going to be in a position to retire and will be working for many years. That would normally be their retirement. I mean, really, what can we say about retirement? It's a 50-year-old concept. The whole idea of what work looks like is truly changing, right? So I think that ultimately we need to get more flexibility. I certainly see more women not in a position to retire because of the fact that, again, they earn less, work less. They are actually also taking care of their aging parents as a result of the economy that we're in. So we need a lot more flexibility, and not even just all of that, but also when you start taking, a lot of seniors I'm sure are upset when they start taking income, having forced to take income, they're just going to lose things like old age security as a result of all the years they've contributed to all these programs. They end up having a clawback on their old age security as well.
Yeah. But the macro point you made, we cannot forget, we need to balance budgets in the long term.
Right.
So you've had that deferral time, and this is part of the budgeting process. So we need to rethink a lot of things if we let this go.
But there's one, let's talk about the estate consideration, because that's something that's missing from the conversation. And that's that there's a power to defaults, and the default being where it is today. Like a lot of people just take that, and they only take that into income. Well, most seniors are at relatively lower income thresholds compared to the working people, which means that they're paying lower tax rates. If we abolish all withdrawals as a mandatory withdrawal and just let people do what they want, there's going to be a lot more deferral, which is going to result in larger RSPs and RRIFs at time of death, which is going to result in a lot more tax pushing up the tax brackets as that number gets added to their income. So the estate liability is basically going to be larger. So there's a possibility, very real possibility, that if we don't, the benevolent aspect of this is that the government's actually forcing us to take or spread that tax bill out potentially over lower tax brackets and have an overall larger picture after death.
Well, exactly. I was going to say that if they die, people die with a big RSP, then their beneficiaries are going to have to pay the tax. On the other hand, if people run out of money, if they live for really, I don't know when that RRIF withdrawal schedule ends.
It
doesn't. And
But those are two different groups of people, right? You have those who can't afford, which fine, we get that. You have those who can, those are the ones with the big RSPs. What I'm saying here is that those people are probably going to have even much larger RSPs now, with much larger tax implications, and potentially be worse off than if they had taken money all along.
But that's exactly what you're right. There is no one size fits all.
And
that's exactly why you need the flexibility and the choice. So in my opinion, more flexibility, more choice is always a good thing, provided to your point, that you can get information and education to the retirees to make the right decisions that are right for them personally.
Yeah, there's no 65 mandatory retirement anymore. People are working into their 70s, into their 80s.
But other jurisdictions have dealt with this. The Americans have something called the still working exemption. If you are still working, you do not have to take what they call an RMD, which is the same as a RRIF minimum withdrawal, and you can defer that. So that model could be copied here.
And that's what we're lobbying for. We just do, CARP does not want to have our members taking RRSPs if they don't need it. Again, many choose to or have to work, and they'll take it later. So it's not a question of abolishing it, but deferring it.
Again, I mean, people are living to 100.
That's it.
And they're afraid of running out of their money.
That's the existential concern of every single
And there's an
senior
argument to be
is
made for the risk schedule to reflect that and even be more conservative, right? So if the schedule is supposed to basically try to keep your income steady over the rest of your life, well, frankly, okay, we have to adjust that. We should be adjusting that more periodically for life expectancy and aiming lower to, like, let's plan for people to live to 105, right? Like, let's try to keep it on the schedule like that.
105, maybe that's
I'm just using, I'm picking a big number to basically say let's
100,
overestimate.
101.
Fair enough.
And there's more after the break. Don't go away. Welcome back. Retirement planning is about much more than money. How will you spend your time? And who will you spend it with? Defining and reframing that will also help you decide how to allocate the money. Jackie, you break it down to 3 separate phases.
Yeah, there's really 3 phases of retirement. The first phase is when you're typically your most healthy. It's called the sweet years of retirement. And that's when you're, living your best life, like you're really living your bucket list life and pursuing all your hobbies, maybe fine dining if you're me, or you're, traveling. So these are the years where you have to consider, okay, that's when you're going to be in optimal health. So that's when you'll really partake in all of these things. And that's also when you spend 100% of your retirement budget. So keep that in mind as well. So that's from 55 to 75. Remember Freedom 55 for anybody who believed that? And then the second phase is from 75 to 80, which is the stay-at-home years. We all lived that during COVID, which is you may not be in as great a health. Maybe you don't necessarily want to travel as far. I have a lot of clients who are grandparents, so we're planning their appointments around their grandchildren's babysitting schedule. So that happens to be where they want to spend their time as well. And really, at that point, you're spending 76% of your retirement budget. You might have hobbies, but they tend to be more local. And you tend to prioritize family and being near family. And then the third phase is really the unknown year. So any time past 80 is when you're spending the least amount. I don't know too many, but if there are any in the audience, feel free to challenge me. Are you fine dining in your 80s? Maybe not so much. Typically at that phase, you are spending 67% of your retirement expenses. And at that point, you're also typically just worrying about healthcare costs and what they might be in the future.
I'm not so sure. I know very active 80-year-olds, and maybe just kind of move those numbers up. Definitely, the beginning of retirement is when people want to go on all those bucket list trips.
Again, depends on biological health and habits, right? So if you've got really good genetics.
Their ideas.
Yes.
Yes.
If you've got good genetics, and you've got also good habits, health habits, then those that sweet years could last a lot longer.
Let's also not forget that travel insurance is pretty much a must, and that gets harder and more expensive to get the older you get.
Yes, exactly. That's right.
Well, yeah, you can count on it being, about 10% of the whole trip.
Yeah, the point really is to say, consider your biological age and think as well as your habits, and think about what your priorities are, because the most important part of your retirement is that 55 to 75, because that's when you really want to do all the things you want and feel like you've crossed off those bucket list items.
Jackie, I'm 82 years old. You really depressed me.
I'm so sorry.
But biologically, how old are you?
I'm totally going to change my life. That's what you just told me.
You're gonna stay home more.
Just staying at home. That's right.
You're not
no more
grand-
fine
Stay at
dining
home.
for you.
It's all going to be fine.
It's okay. We have people over 80 and
Push
over
back at-
82
push
down
back
the
at me.
hall who run this place.
Yeah, I mean, this is more about biological age too, right? Because I told you about my Zumba Zumba partner who's 95 doing Zumba with me. So it all just depends on that too.
Let's talk about women. Retirement, as you keep pointing out, is different for men and for women. And also situations where my husband, who is probably one of the most athletic specimens for his age, well, he's retired, but I'm not. And yeah, you're nodding your head.
I'm nodding my head. Is he driving you nuts yet?
No.
Okay.
But he, because he's cycling 4,000 kilometers in a season and play squash and tennis, I feel badly about not taking some of those longer trips.
So, I mean, one of the things I will not just focus on women that I think is important we haven't talked about is identity post-retirement. It's what are you going to do with your time? You've spent so much of your life in a career and identifying as something that you did. You lose that, what do you become? And that is something that causes an immense amount of stress and psychological trauma to people who aren't ready for that. So the question becomes, what are you retiring to? What does that life look like? And if you think you're just going to stop and suddenly golf like every day of the week and you don't golf now, you're kidding yourself, right? So we often encourage people to basically spend the time doing the stuff they're going to do in retirement when they're basically still working. Now, the other aspect of it is the relationship, right? You guys have been so busy for so long doing different things. What happens when you're staring at each other in the house? One of the fastest growing segments of divorce for years has been gray divorce.
Right.
Yeah.
Because they really weren't spending time together. And is this the same person you want to spend the last stage of your life with? So it can be difficult.
Yeah, it's not a vacation, right? It's not a 30-year vacation. I think we have to revisit and reconceptualize retirement because it is about purpose. There's this whole thing now about your ikigai, which is a Japanese term around purpose and having purpose in retirement. And maybe because so many people can't afford to retire, phasing retirement out rather than it being like an event, it be like a journey where you're working fewer and fewer days.
Yeah, and as you said, it's a concept that's like 50 years old. Like the industry basically invented it.
That's
Prior
right.
to that, you stopped working.
What about the money part? I know people who go in and out. I know people who basically fail at retirement.
Yeah.
And after their fancy retirement parties, they're back at work within a number of months, even though it might not be a full-time job,
Yeah.
say it's a contract, but doing more or less the same things.
For the money? Well, you fail to plan, you plan to fail. Who told them they could retire? Because too often, the number is, oh, look, my pension started, I'm going to retire. Your pension has nothing to do with your retirement date. It is when money's going to start coming to you. Your retirement date, your effective sustainable retirement date is the date that your financial plan says that you actually can continue doing what you want to do.
I think it speaks to the fact that retirement as a concept has completely changed. Again, we've come from an industrial era when people died young, and so retirement was something
2 years after the age of 65.
Something you hope to
Not
do.
30 years.
That you'd live long enough to enjoy it. But in our members, when I talk to them across the country and meet them, for them, retirement is. Retirement, the term itself, is what they did to earn a living, pay the mortgage, support the kids. But none of them that I meet are actually retired. Most of them tell me they're busier than ever. And you hear this thing over and over again. I wonder how I did everything I'm doing now when I was working.
I hear that.
I think that so much attention is paid in retirement to financial matters, and health. And people not thinking of like, well, what am I going to do for the rest of my life?
Purpose and identity.
And it's like
huge.
at least 20, 30, even longer.
It is.
And it's actually men who suffer more.
That's right.
From the, when the phone stops ringing because they're retired.
I have a friend whose father committed suicide due to his loss of identity after retirement. That is very real, a possibility, unfortunately, a very sad one. But the reality is that when you have literally your identity wrapped up in what you do, and then that ends, and you lose the social connections.
Exactly. You have no reason to get up in the morning.
That's it. Like and I have another client who, he prevented that from happening, but he was getting depressed. And he sold his business. He thought, great, no problem. And he basically told me, he said, I used to wake up and I would figure out where I was going to go eat for lunch that day. And that's all I had. And he said, finally decided he went to a cruise ship booking center and said, I'm thinking about buying a business. How much is yours for sale? And he needed a place to go. And his son ended up being in charge of the place, and he ended up going in to keep busy, and it gave him purpose.
The term I've heard for that is a legacy career, is that you need to figure out what you do after your regular stuff, but think of it as a career. It's another career, and you need to be excited about it and be enthusiastic.
Yeah.
And that's a key.
And if you have the cash, ultimately what we're helping clients to do is have the money so they can stop working if they choose.
It's a
But that
choice.
doesn't mean they have to stop working. They can continue to do whatever drives them, have their legacy career, take care of their grandkids, whatever the case might be.
So it's the option of retirement, not the obligation
Exactly.
of retirement.
It's assets being able to retire. Because you don't know what your health is going to be like. And that's the conversation we have with people. You don't know what your health is going to be like. So being able to know you can afford to stop working is the key.
I wanted to add something to what Jason was saying, which is that sometimes the retiring and the going back to work isn't necessarily a change of mind. It's a planned act where you may have, a lot of companies may use their pension plans, their private employer-sponsored pension plans, as a workforce management tool where they try to get people out, but those people are still healthy and looking to work, and they'll take that pension and they'll go back to work somewhere else. And even, it's not just with executive white-collar type jobs, it's also in the union space, in trades, for example. Some of these private multi-employer trades pension plans have very generous early retirement benefits because you've been working, physically for 20, 30 years. So a lot of guys, what they do is they will retire early. They'll take that generous pension and they'll go work in the private sector as a bricklayer or whatever else they might do.
Or teachers substituting after they retire too.
Yeah, or training people. So I'm sure as financial advisors, you take not just the government benefits, but also any private pension plan and how that's structured into account as well.
100%.
Okay, we've got to take a break. We'll be right back with more of the Zoomer. Welcome back. We've been talking about how to minimize taxes in retirement, and one of the best ways is to have a stream of income that's not taxable. That's where tax-free savings accounts come in. The key is advanced planning, but what can you do if, despite your planning, you find you just don't have enough cash? Can a reverse mortgage be the answer? And are there other options?
I have a structured settlement and I need cash now. Call J.G. Wentworth, 877 cash now.
I have an annuity, but I need cash now.
Call J.G. Wentworth, 877 cash now. 877 cash now. They have...
I love that commercial, but I hope I never have to take them up on whatever they're selling, which I'm assuming involves getting however many cents on the dollar of what I've got, right?
Yeah, I mean, these are US-based ads, obviously, and I'm not even sure that some of that stuff is even legal in Canada in most provinces. Securities laws are a little bit tougher here. But again, the concept, as I'm sure you know, things like a reverse mortgage, it's not far off, where you take an asset and then you basically get a stream of, get a pool of cash and you never have to pay it back. So it can work for some people, for sure.
Okay, let's talk about reverse mortgages, which apparently are better than they used to be.
Yeah.
Now, don't get me wrong, reverse mortgages do have a bit of a sordid history. When they first came out in the first few decades, they were subject to their fair share of fraud and predatory practices. But today, there's some pretty strong regulations around that. There's more competition. So consumers are more protected today with reverse mortgages. And don't get me wrong, I don't own any reverse mortgage lend. I don't have any interest in it. But typically, you have your three pillars of retirement income, right? You have your personal savings, your government plans, and your private employer. So this reverse mortgages could be a fourth pillar if you look at it with a very careful eye and with the help of someone like a financial advisor, because they are quite complex still. So you can, it's basically a loan product that you take against your house, and you have to have at least 50% equity in your house. You have to be at least 55 years old. So then what happens is you can either take the loan as a lump sum, or you can take it in monthly installments. So there's various different types
Or
of...
you can apparently just take as much as you need.
That's
now.
the lump sum.
You can also do like a line of credit as well. Not just a lump sum, but also a line of credit.
And
then
the
what happens
interest rates are on the higher end, but if you need the money.
But you're not paying monthly contributions, so your cash flow needs every month aren't changed. Now, where the negative is that compounding works against you. right? So your loan grows every month because you're not making payments on it. And over a long enough timeline, it can erode into the rest of the value of the equity of the home. So, these are great solutions when a couple of things happen. A, the person's not willing to downsize. If downsizing is an option, that's often a better option because the cost of maintenance of the house comes down as well, as opposed to maintaining the larger one. Two, if they're of advanced age. When people in their late 60s talk to me about this, I'm like, well, wait a sec, it's too early, because the amount of time you're likely to live and how long that interest is going to compound against you, you're definitely going to have very little left over. And then the last piece is you got to be aware of is that, a lot of people, I think right now, some of the ads are talking about you can still hold on to it and get the appreciation. Let's get realistic. What happened in the last 15 years in this country on housing prices isn't about to repeat itself. If it is, the housing crisis becomes,
He's right,
what's the word, worse than crisis? Like it's brutal. So to think that you're going to sit around and outgrow the compounding of this loan product over the next 20, 30 years, I think is very misguided.
Now, FP Canada is actually, so FP Canada is the Financial Planning Standards Council, and we are recommending that as that fourth pillar that you're talking about because so many people haven't saved enough for retirement. And then the other piece is care costs. It helps to help people understand, well, if you have 4 years of care costs or 5 years of care costs, what's that going to do to your retirement plan? Will you need to tap into your equity? And just giving people those options so they understand.
I think we got to be careful with the use of the term tap into equity, right? Because people hear that and they think it's positive. We are taking out debt.
Yeah, we're taking out debt.
And there's nothing wrong with that, right?
Right,
But there's a big difference between a 66-year-old and an 85-year-old doing that.
We're talking about an 85-year-old.
Yeah,
exactly.
And it seems like people who are not worried about what they leave.
Right.
Well, frankly, to be frank, they should be more worried about not running out of money than what they leave behind. Everybody should.
That's exactly
right.
Right.
Yeah.
So it's
no one
really,
should be eating cat food because they want the kids to have a big inheritance.
Exactly, and it's just about giving them options so that they know. Because some people, once you factor in care costs, and many financial plans never used to factor in care costs, really puts people at a disadvantage for being able to afford to retire.
And there are also some products where there are insurance for care costs, but those are expensive, I think.
And there's very few of them on the market left. I
And
mean,
a lot of those providers have stepped out of the market
Totally.
because the claims that they were getting were just overwhelming, and they said this isn't worth it for
I haven't
us.
seen any long-term care insurance sold in Canada in years.
Sun still has kind of a tail risk product that exists, but it's not their full robust
It's
one
not
that used to
very
exist.
common.
I mean,
We talked about it, but
I
people don't
have
get it.
some regular callers on my show, and one of them, he's obviously very well off, and there's a relative who needs 24-hour care, and he said that it's $200,000 a year.
Easily.
Yeah.
That'd be more than that, I would think, if it's
Yeah, I
24
mean,
Think about
hours.
it, it's
I'll say
3
two
shifts
things.
a day, right?
But
It's
let's
almost
also
like
talk
paying
about the
for
realities of how this impacts a financial plan, right? If you're, financial planning for your retirement expenditure to drop by 30%, like the numbers say, you're not leaving a cushion, right? All financial plans need large cushions.
Yeah, that's right.
And then in addition to that, let's also remember that when that happens, the odds of you living the projected extra long life expectancy that we use to be safe shrink dramatically. So yeah, the costs go up, the timeline shrinks, and if you had a cushion, you should hopefully be fine.
Agreed.
One advantage to reverse mortgages is the alternative to downsizing. Now, downsizing sounds really great, but for a lot of people who are really they're
Home is-
older,
home is
they
where-
live in a neighborhood,
Yeah,
they
home is
know
where the
people,
heart is.
right? It's very traumatic to move out of your home because you not only move out of a home, you move out of your community,
that's
you move
right.
out of your routine.
And it's also condos, right? If you want to downsize to a condo, there are condo fees. It's
there's
not
cost of maintaining a
necessarily
house.
that
Sure,
much
property
cheaper.
tax,
But there's
everything,
cost of
yeah,
maintaining a home also, right? Like that we don't necessarily think of every day. But simple, just to build on what you said there, a client of mine, when he was in his late 70s, he told me, what piece of advice. He says, talk to all your clients about making a downsize decision when they're in their late 60s. Because you know what? You think I'm sharp, but I forget where things are. And I take great solace in being very familiar with my surroundings. And I could have done it 10 years ago. Now I feel like I would be upending everything. So a lot of my conversations with clients are about, what does the retirement property look like? What is that environment? What's that community going to look like? Because if you make that decision, you can take money off the table early, and you can be more prepared for that decision. down the road.
Absolutely, because the other issue now, and my clients are seeing it with their aging parents, is things happen suddenly.
Yeah.
With a care situation.
Crisis.
That's right, which means all the numbers get thrown off.
And it doesn't have to be a crisis, right? It can be, I've seen several cases where the family has not been upstairs or downstairs in a 3-floor home in 10 years, right? Like they live on the ground floor because the mobility issues. But now you're paying for this giant house that you're using 1/3 of.
Exactly, and now if you're in a crisis, right,
Yeah.
then you have all of these other factors to consider. You have to do it very quickly, and where can you get into, and what does that cost, and all of those things.
The idea of having shows like this is not to be in a crisis.
Right.
And we have to leave it there. When we return, we have questions from our audience. That's next. Welcome back. Before we get to questions from our audience, I have a question. And I was late getting to tax-free savings accounts because I was so focused on cutting my tax bill with RRSPs. But those TFSAs, well, they give you an income that is not taxed in retirement. So how important are they, and how should people start if they haven't got to it very quickly?
It depends, and Jamie knows this because he's written about this. If you have to choose between RSPs and TFSAs, it depends on a number of things, specifically income in working years versus in retirement. So that's an entire separate question. Look, should you be using TFSAs? If you have money that's not going into an RSP, is in a taxable environment, 100%. Why would you not do that? But as for that versus other options, that is a financial planning question that involves many trade-offs.
And I would say the best thing about the tax-free savings account, it is literally tax-free, meaning not only is it completely tax-free your entire life, there is no age limit, there is no minimum withdrawal. You can take this right up until the year of death, and every dollar that comes out is tax-free, doesn't include an income, and doesn't even affect your OAS.
Exactly, and also you can double that up with your spouse. If you have a spouse, then you get their tax-free room as well. Even on death, that they can keep that room if one of those partners pass away and you maintain that TFSA account.
Although, if they don't use all the room before death, that is lost.
Right.
So I've even written articles on if
top it up.
If you can
Right.
borrow money to top it up, if they're on their deathbed, that's a smart idea because you can always keep because withdrawals out of a TFSA, you get the room back the following year. So spouse inherits deceased spouse TFSA, pays off said loan, has the room going forward.
So ultimately it's optimize the TFSA as much as you can. And the best way to find out is to maybe talk to somebody to make sure you're optimizing it based on your circumstances.
Yeah, I agree.
Yeah.
Okay, now let's go to Robert in the audience. Hi, Robert.
Yes, the panel has really discussed RRIFs and LIFs and minimal withdrawals, but what about if you have some wealth, how fast would you recommend drawing down RRIFs and LIFs, and would that be the first thing you draw down?
The question is, what are you trying to accomplish, right? Like, what is your level of funded contentment? What is the lifestyle you want to live? From there, it's not about which one do I do first. More often than not, it's a combination of factors depending on it. So there is no one answer I can give you. A LIF is a life income fund. So basically, when you take money from a pension and transfer it to, it's basically, you have the limits, it's locked in. So there's a minimum that has to be taken out, like a RRIF, but there's also a maximum that can be taken out every given year. So because of those handcuffs, wherever possible, if you are taking the minimum from both and you need extra money, they're both taxable, take it from the LIF up to the maximum, because that basically leaves the flexible account of the RRIF available for you later.
I mean, we get the question all the time in terms of taking money out of the RRIF early. Should I, if I'm a lower income? I mean, our general advice is we leave it in as long as possible because we're getting the tax-free growth. That being said, there are arguments to be said. If you are in the lowest tax bracket, maybe we do take out a little bit extra, more than minimum each year to basically fill up those brackets. Yeah. Then we take that money and then put it into a tax-free savings account, as an example.
Yeah, there's cases where people have no taxable income in early retirement, maybe when spouse is working. You can take out the first, $12,000 to $15,000 tax-free, and then the first bracket stops at like 50,000. That's 20 cents on the dollar. Yep. It's that's a really low tax rate to take money out.
Right.
That's why it's all about, like, okay, do you have a spouse? Can you split income with your spouse?
Right.
Like, there's a lot of factors. It's all about optimizing your circumstances as much as possible.
I think
how do you do that?
One thing to be said here, that we haven't said, is that Nobel Prize winner Bill Sharp called decumulation planning or retirement planning the most difficult, dirtiest problem in all of finance. Mm-hmm. There is nothing but a series of variables, bunch of rules. Everything's variable, nothing's a constant. So there's so much that goes into it. So the answer, it depends, truly is the only answer for most cases.
And it depends on what you want to achieve ultimately.
Okay. When we come back, final thoughts from our panelists. Welcome back to the Zoomer. It's now time for final thoughts from our panelists, starting to my left.
The thing we haven't talked very much about today is something that concerns me, which is lifetime income for people that don't have a defined benefit plan and that want to have lifetime income in a cost-effective way. It currently doesn't exist, and we need it.
I was just going to say, you know, if you're a woman, don't wait to start looking at your numbers. At the end of the day, compound interest can work for you or against you. So use compound interest to optimize your circumstances by deferring your pension, deferring your OAS, CPP, and really understanding how much you need to live for retirement. Start getting those numbers so you can actually make better decisions and be more confident.
I just wanted to touch on the one thing that we didn't get a chance to talk about, which is annuities. As actuaries, we look at risk, and the two biggest risks for retirees are investment risk and longevity risk, the risk of outliving your money. So to Keith's point about not having a defined benefit plan, if you have something like an RSP, you could consider purchasing an annuity through an insurance company where they pay you what is effectively a lifetime monthly pension and takes the investment risk and the longevity risk off your hands.
I think planning and planning early is the key, and this is a very complex puzzle to solve. We advise people to get a financial advisor, but do your homework because not all financial advisors are created equal. Make sure that one is working in your interest, in the interest of your retirement.
I'm going to reiterate, this is the dirtiest problem in all of finance, right? I wish it was easier for people, but in that difficulty, there is opportunity. There's opportunity to go right or wrong, and basically a good financial planner can help you not only live the life you want to live if you basically work with them, but the studies have shown there are more people who have proper plans in place, are more confident in retirement, feel more secure, and are less stressed. And frankly, that is a big component of living well when you're in next advanced stage, is taking that stress away.
And again, I would agree, of course, the importance of financial advice is probably the #1 lesson. Hopefully people watching today will get out of it. Have a financial plan, have advice, but remember taxes. I always emphasize taxes are the biggest expense that people have in their life, even more than housing in Toronto. So if you are going to focus on one thing in terms of financial strategy, look at all these different taxable accounts, RSPs, RRIFs, tax-free savings accounts, or annuities, and try to minimize that tax, because with a financial plan, you'll be able to have more money in your retirement.
Planning your retirement is about much more than money, but if you get the money right, the rest of it will be a lot easier. And that's it for us this evening. To get in touch, send us an email at comments@thezoomer.com. As always, thank you to my panel and to you at home. We'll see you soon. For now, it's time to zoom out.